Hello and welcome. You're watching KYC. I'm Harsh Saita. With me today is Varsha Chandani. We're going to try and break down MedPlus Health Services Limited. It's a very strong set of numbers, frankly, in Q4 that MedPlus clocked, right, Varsha? Their margins went up closer to 9% now. And you're seeing good traction, therefore, on profitability. Top-line growth also looking fairly healthy, double-digit in that sense. And therefore, the stock was doing very, very well in trade through this week. And that's why in focus. But more importantly, what I really want to know about MedPlus Health, and this is where it starts to get fascinating. So it's obviously a health, it's a retail health chain. And what they're doing currently to increase margin is they're doing private label scale up. They're doing their own products, their own labels, and they're trying to scale up that business, which is better margin, right, Varsha? And if that were to continue, you could well see margins inch even higher. Whether that actually happens or not is something I want to ask, and therefore, where should the realistic margin number lie as private label scale up is to happen? So sustainability of this margin number at 9%, or how much more can it go up by? That will obviously aid the return ratios as well, Varsha, because you will see profitability go up. The other piece is with regard to quick commerce. Now, they of course have retail stores. If I could equate MedPlus's business to the business of a noble chemist or of any chemist near your house, they don't just sell medicines and products relating to health. They also sell other products, things like waters, things like chewing gum. And those also kind of add up in terms of their top line as well as margins. But quick commerce is taking that away, and therefore, can they sustain the kind of competition that's coming through quick commerce will really be the question. Yes. The last one is top line growth. What's next? Can they continue to grow at double digit for the foreseeable future? We were just talking, Varsha, 4,700, 4,800 odd stores. They're doing 100 stores a quarter. They're expected to expand their store count by 600, which is a 15% odd growth when you're looking at it over the next year. And therefore, implied 15% growth should come straight through to the business. You would want to see whether they can do even better on the top line.
Actually, on that, Harsh, with respect to MedPlus, your focus should be more on EBITDA and bottom line.
Correct.
Considering the increase of private label contribution to their business. Yes. So that would be really interesting how they're going to grow their, EBITDA and bottom line for that matter.
Yeah, absolutely. And we will look at the numbers, and that will give us a sense as to how those numbers are taking shape. But first off, with regard to the business itself, let's break this one down. Let's start off with the products. So it's a pharmaceutical and wellness products business that they're in. They're retailing. They're basically a retailer of these products in India. They're the second largest pharmacy retailer in India, which kind of underlines the depths to which they've gone with regard to expansion, as well as their seriousness with regard to the retail business in India. They added 100 stores in this quarter. I did speak about it. They have a total store count of around 4,800 odd stores now. What do they sell? I'll start with medicines, of course, but outside of that, they are also into personal, home care, toiletries, baby care, soaps, detergents, sanitizers. They are into a whole host of products, FMCG as well, along with the pharmacy products that they obviously sell as a core pharmacy business that they do. Let's look at, so those products coming up on your screen slowly and steadily. But let's look at the sales mix now. And that's where it starts to get interesting. Varsha, you want to take this? You want to explain this in absolute layman terms?
Sure. So let me start with, branded pharma, the typical drugs that you see in any medical. So in Q4 FY24, it was almost 69%, which they've reduced to 63%. Well, there's a reason for that. That branded non-pharma means your FMCG kind of everything, which doesn't include your, drugs or medicines. So that has also decreased. Now over here, private label is the thing which is of interest of every investor. The private label has increased from 8.5% to 13.6%, and that's the reason, we have seen that margin improvement and that's the reason you have not seen that much of growth in top line, because this is a low volume and high margin business. Then private others have also increased. So these two are basically the reasons why you're seeing the EBITDA growth or EBITDA margin growth. And others include your, just Harsh was saying, your Lays, your water bottle, and your chocolates. So that has, I would say it's flat at 3.4%. So this is basically the sales mix that a company has. So interesting part here is private label and private others, which has the contribution has increased and which has led to EBITDA margin expansion.
Yeah, so that's what's driving margins. Let's look at the sales. So we've looked at the sales mix. Let's look at the store level revenue. This has been on a declining trend, Varsha. Why is that so?
So what happened, Harsh, that because your, as I said, that your store level revenue growth is expected to decrease, and this is gonna be at an inflation rate that the management has said. And one of the reasons is because as your store matures, the growth subsides, your sales growth, your SSG growth subsides as your store matures. So this is one of the reasons why you're seeing this, going down, and you'll see this go down as and when the store matures.
Okay, so is that a good sign, Varsha? Is that a bad sign?
I wouldn't say it's a good sign, of course, because
but that's the nature of the business.
Yeah, that's the nature of the business. You can't do anything of that.
Okay, fair point. Now we're talking about store level EBITDA. Now that it came off in Q1, but thereafter we've seen it climb steadily towards 11.5, much in line with the way in which we've seen private label grow as well.
And you'll see this kind of range, like 10 to 11% kind of store level EBITDA margin in future also. So no much surprises here is expected.
So sorry, if I can just wind it back one slide and look at the store level revenue growth. This has come off, but now with a pickup in the store count which is anticipated, this should get better.
Yes, this should get better.
Perfect.
And that's the reason, so see, in Q4 FY24, you had a good store revenue growth. And as and when your the number of stores coming up goes down, you're going to see this kind of trend. But once that store, growth picks up, you're going to see a good amount of store revenue growth, that SSG growth. But overall, for a longer period of time, you can expect like 4 to 5% of growth when it comes to, SSG growth. Yeah.
Perfect. So that's how your store level growth will likely be. We've spoken with Mr. Madhukar Reddy, who's the Managing Director and CEO at MedPlus Health Services, and we'll get you that conversation that we had. But first off, with regard to the KYC metrics, we'll break down the company, try and see what they've done over the last 3 to 4 years to make this more meaningful for you in terms of how the conversation goes. Let's start off with all the metrics that we look at. We'll start off with the income statement, the balance sheet, the cash flow and return ratios. Thereafter, we will look at street cred, street coverage, shareholding and valuation. So we'll look at all of those 8 metrics. We'll see how this one stacks up on each of those, and thereafter go and speak with the management. Varsha, income statement, you want to go?
Yeah, thank you for that. So let me start with income statement. If you see, the 3-year CAGR when it comes to your revenue is at around 18%, while interesting part is EBITDA. 3-year growth is almost 21% because of the increase in the margin, because of increase of contribution when it comes to private labels, and this will increase in future also. If you see, net profit is at 18% CAGR growth. Now over here, if you see the interesting point, and what I think is, going forward, your EBITDA and bottom line growth will be more than top line growth, because as and when your private label contribution grows, your top line will not increase that much, because private label is a low volume, high margin business, but your bottom line and your EBITDA will increase substantially in next few years. So overall, when it comes to income statement, we would give a thumbs up, because overall the financials looks good.
So decentish growth on the top line, your EBITDA margins getting better, scope for it to continue to expand really will be the question, and we will take the management's view with regard to that, and therefore you've seen a decent surge in profitability as well. Clear thumbs up with regard to that one. Let's look at balance sheet therefore. Now when you're looking at the balance sheet, first off we need to keep in mind that the market cap of this company is 11,000 crore. The book value is just about 2,000 crore or maybe 1,800 crore. And therefore, the book value to market cap is obviously extremely stretched in that sense. So your price to book value, as one would call it, is quite strong. When you're looking at the borrowing number, all of that borrowing number that you're looking at is lease liabilities. Essentially, it's a lease-based business, and generally we don't count lease liabilities in your debt. But that borrowing number as of right now, just wanted to reflect that, is completely lease liabilities, and therefore no concern whatsoever with regard to that borrowing number. Let's look at cash balances, which is sitting at 367 crore as we speak. It's a cash generating business, right? The only possible working capital requirement there within that balance sheet will likely be on the inventory count, because as store count climbs, you need more and more inventory to sit on that balance sheet of yours. And that's probably where some of the working capital requirement is going. But outside of that, it's sitting on a healthy cash balance versus the total market cap, and you're seeing zero debt. So clear thumbs up with regard to the balance sheet. Varsha, cash flow?
Yeah, so when it comes to cash flow, good growth from FY23 to 25, of course, because of, higher profits. And also, if I were to compare FY24 versus 25, in net cash flow, if you see, there was a negative 137 crore in FY24, while for FY25, it's negative 5 crore. Why this much of change is one of the reasons is in FY24, your huge cash was actually deployed in inventory, which dented your cash flow from operations. So in FY24, 196 crore of cash was deployed in inventory, but in 25, around 5 crore, only 5 crore was deployed in inventory, and that's the reason you're seeing that spike from negative 137 crore to negative 5 crore. So this is one of the good things when it comes to cash flow from operation, because now your money is not stuck in inventory versus in FY24 where it was stuck. So overall, yes, good show when it comes to cash flow.
So good show on the cash flow. Let's look at return ratios. Therefore, they've been climbing on a consistent basis, given the fact that you have better profitability which is coming through. Why is there better profitability? Because there's margin improvement, but a 10% return ratio is obviously too small. You want to see a better return ratio number when it comes to any business, and therefore asking for more. But because it's on an improving trend, we've given this a neutral. Let's quickly look at shareholding pattern, Varsha. Yeah, so
very interesting thing. So because this is a more kind of consumer-based company where, FIIs and DIIs are interested, that's the reason, FIIs share has increased from 14.7% to 15.6%. That's a very good sign. Even DIIs has, so there's a little bit of a downside when it comes to DIIs stake from 27.9% to 26%. But overall, good show when it comes to FIIs, but DIIs stake has been reducing. So we would like to give a neutral kind of rating.
Yeah, that as well as the fact that promoters holding 40%. Generally, we've seen Indian promoters hold far more. And that's why the slightly more cautious rating. The last piece is with regard to number of shareholders, and this is something that stands out. I've not seen too many companies where the number of shareholders remains flat over the last 3 years, and that has been the case with this one. 82,000 shareholders in FY22, 74 in FY23, 75 in FY24, and 83 in FY25. So no real substantial chop and change with regard to number of shareholders, which kind of shows stability as well. Doesn't show too much of over-excitement that the street would generally see with regard to some of the retail businesses. Something, again, to keep in mind. Very quickly on street cred, I want to mark out that the stock has done ever so well. It's up 38% in the last year, 27% in the last 6 months, 14% in the last maybe year-to-date period or so, and therefore it's clearly been an outperformer. We've given this a thumbs up just given the way in which it's moved, and therefore street cred brushed away. Let's talk about street coverage.
Yeah, so there are 7 analysts who have given, all have given buy call. 0 has given hold call and 0 on sell call. So basically everyone is bullish when it comes to MedPlus, considering the EBITDA margin growth expected and considering the good business model overall, if you see. But the upside potential is only 4.5% harsh. So, not good upside left, considering the higher valuation or premium valuation that the company has been given?
Yeah, absolutely. So that's something to look out for, that there's not much upside left. Let's look at the valuations, therefore. Begs the question as to how it's valued. You look at the price to earnings multiple currently sitting at 77 times, trailing 12 months. Even if I look at the 1 year forward, it's 58.5 times with a lot of execution, which needs to be done. And then you're looking at FY27, which is at 47 or rather 43 times. So what it's calling for at 43.2 times FY27 is plenty to do with execution to get there. And therefore, we're a little bit cautious on this one. As a pure play retail pharma business, you would want this to be valued slightly in a more reasonable fashion, given that some of the other retailers are also available maybe at a slightly lower valuation when it comes to FMCG core. So maybe some more to be desired from a valuation perspective, of course, not in the company's hands in terms of stock price action, but that's something that's part of our analysis. But what we'll do is let's shift focus to the management. Before that, let's look at the ratings very, very quickly. In terms of how they stack up: income statement, balance sheet, cash flow, return ratios. That's how it stacks up. Remember, return ratios on increasing trend, just about reached double digit. The only concern here is with regard to valuation. All of the other metrics are okay. And therefore, we give this a 5.5 on 8. Let's quickly go across to the management. Varsha earlier spoke to the Managing Director and CEO, Madhukar Reddy, who talked about the company's growth trajectory going forward. Listen in to a slice of that.
Mr. Reddy, private label, which is the highlighting factor when it comes to MedPlus, and which is actually the interesting point. What is the target that you have set, say, for next 3 years? Because you've done a lot of, I would say you've done a big transition in terms of product mix, but how are you thinking when it comes to next 3 years? Because I believe currently it contributes almost roughly 14% to the top line. So where you want to take this private label contribution?
Sure. So let me actually put that in the right perspective. Our private label, we sell on a MRP of 100 rupees. We sell it at around 85, we sell it around 45 to 50 rupees versus a brand which we sell at 80. So when a brand is substituted, you will see a top line dip out there. So the right way to look at it is, match the MRP sales to MRP sales so that you actually get the volume sales out there. If you look at it that way, 20% or 21% by MRP was, contributed from the private label side in the last month of last quarter, actually. So if you look at it, from 0 in June 23, we have now come to almost 20-21%. And this is, mind you, 20% of the 80 which we sell in medicine. So if you look at it, 25% of all the medicines which we sell today come from the MedPlus brand. So pretty steep, growth curve, I would say, on that side. But now that the early adopters have come in and all, I expect that the growth will be slightly slower. We expect that we'll grow only at around 1% every quarter kind of stuff. Q1 could be slightly weaker on that side because I think we've probably taken in some extra sales in Q4 of last year. So 1% every quarter is the number we are guiding towards on the growth of private label. That's one. But that is for the next 6 to 8 quarters. At some point, I believe, as, let us say, more and more customers understand that all the medicines which are made in India are more or less generic, and all you need to do is pick the right manufacturer and get the right price. I think people will start switching towards the generics more and more, and we could actually see, I would say some kind of a tipping point at some point of time. That will be aided by what the government is doing on educating people about generics. What I believe my competition will also, sooner or later come around and basically start selling this stuff. So when everyone starts talking about this along with us over a period of time, I expect that the entire country will, at least this medicines will get completely genericized. So I don't see any, I would say, cap on the amount of sales. But in the near term, I would expect that, we'll probably grow at the rate of around 1% every quarter.
Got that point. Also, on the store expansion, so last year you opened around 305 stores, and if I'm not wrong, this year you're targeting 600 stores for FY26. And I believe you have around 400 crores of cash, so you won't be requiring any external funds, right? So how will your margin shape up considering the store additions that you have for FY26?
So the 600 stores will have a small lag, let's say, on the drag down on the margin, but not very significant because now it is going to be on a base of nearly 4,700 stores. So I don't really expect it to be a huge drag, I would think, but there will be some. As you rightly said, we have the money in the bank. We don't have any debt at all. So we could basically borrow if necessary. But I don't think it'll be necessary given that we are adding only around 600 stores this year. That should not take us more than 170, 180 crores to actually open, and that includes the inventory and all. So cash-wise, we are, good. Growth-wise, we should, come back once our warehouses and all are in position and we start doing things the right way on the back end. And once we align our front-end staff also more towards a top-line growth rather than just only towards a private label growth. And yeah, and on setting up the store itself, I think, we're more than capable of doing that. Although we did only 300 stores last year, that is kind of a small, I would say a dip for us. And we were just, kind of going slow to make sure that the back end was all in place for future growth. So yeah, I think we're good on both capability as well as money side. And I don't think that the effect on margin will be too big. The drag will be too big, yeah.
Understood. Also, sir, so in last 3 years, if I were to see about your, revenue CAGR, you have grown at like 18% CAGR in last 3 years. Now, I believe that the increase in private label will actually, drag your top line. So just wanted to have your view, what is the target that you have set when it comes to sales growth, for FY26?
So I would say high single digits is what we're thinking at the least, right? I don't think it's going to be less than that. But profit-wise, I think we'll actually become much more profitable as we go forward. So it's not going to be only about, top-line growth for the existing stores. It's also going to be about adding new stores. It's also going to be making each of the stores more profitable for us. So I think, yeah, I would be comfortable in saying high single-digit growth on our stores. At least that much.
Got that. So, okay, so not concentrating on the revenue growth, I understand that point, sir. But then what is your estimates when it comes to EBITDA growth and profit growth? Because I believe that because of the increase in the private label, you might grow over, 20-25% of percent. So, am I right on that track?
Pretty possible. Yes, I would think so. Given that private label continues to grow, I think our growth in profit should be higher than the growth in top line.
Got that. Also, you also talked about your same store sales growth, sir. Now, what is the plan when it comes to your same store sales growth? How much are you targeting? Because I believe in the last few quarters you have grown like in 4 to 5% kind of same store sales growth you have seen. So what is the outlook there?
Similar, I would say, given that our focus will continue, while we will, start targeting our top line growth slightly more than what we have done in the last 1 year. I think, the bottom line though we'd still be focused on private label. So I would think our growth will probably be around the same number. As I said, the 600 new stores, I said, we'll grow by around high single digits or slightly, maybe in the low double digits kind of thing for the entire company. But a lot of it will come from existing stores only. I don't expect that the 600 new stores are going to add significantly because they'll be spread, their opening will be spread right through the year. And they do tend to go slow when they actually start off. So most of the growth, whatever you see, will come from the existing stores. So you could take that as SSG, I would say, for the entire company.
Understood. Now, Mr. Reddy, talking about competition, let's say a competition from quick commerce. You have this sort of trend going wherein, all the medicines are being delivered at home in 2 hours. Now, if you were to start, I believe we have started the services in few of the cities, but if you were to start these services considering no delivery fees, what is the kind of drag in margins you can expect from this kind of trend going on, and what is the competitive scenario that you are seeing when it comes to quick commerce?
So quick commerce or medicines may be slightly tougher, mainly because the number of SKUs are so large, and the SKUs which sell in each zip code completely vary from other zip code and all. So see, there's always going to be a trade-off between fill rate and speed. If you want the full fill rate, you cannot really get it in 10 minutes or 20 minutes. So we will watch the overall situation as it unfolds very carefully and see if the customer preference is for, let us say, a really, really quick delivery, in which case we can easily do it. Given that in each of the cities in which we are present, we have more than 450 odd stores, it is easy for us to convert a portion of them into delivery points for doing the quick commerce delivery. Customers, I believe, if they really want quick commerce delivery, I think they are more than willing to pay for the delivery cost. A lot of them do it right now. So we even today charge 20 rupees per delivery. So we'll probably increase it slightly if the speed has to be increased. But I don't see that as a big lag. If there is any benefit, it'll probably come from, some of the general goods, which we'll also end up selling along with the medicines, and that will be additional sales when we actually do it. So I'm not really too worried about the actual lag, which that kind of operation can entail. But we're still not quite sure if the trade-off between fill rate and speed is going to be favorable towards speed by the customers. If it is, then we will definitely do that.
All right, Varsha, there was one more question you spoke to him about recall.
Yeah, so I was actually speaking. I actually asked him if he can quantify, the number, because he has not quantified the number. So, but he said that definitely the bottom line will grow much more than top line, much faster than top line, and they're going to continue the growth trajectory that they've seen in the past, especially when it comes to profits.
Okay, so that's the outlook with regard to MedPlus. Hope you found this helpful. From Varsha, myself, everyone who puts the show together. Thanks so much for watching. Stay tuned to NDTV Profit.